Hi, so welcome to the video lecture. So let's continue to finish our slides and lecture. And after this lecture, I will give you a short example to explain how to deal with the main product and the byproduct. So what's happening here is the main product is defined as basically this process yields one product with high sales value compared to the sales values of the other outputs. So basically, you have one particular product with a high sales value, and the rest they have a lower sales value. And for ones with a lower sales value, then we consider they are byproducts. Okay, if you have several, two or more products with a high sales value, then they are joint products. So this is basically what we're looking at, the main product and the byproducts. So the rest of the lecture will focus on the how to deal with the byproducts in the manufacturing process. So we have only actually 4 slides left. So the first slide is about this particular example. Okay, this particular example. So what's happening here is so this timber, the timber is going to be processed to the main product called a fine grade lumber, and it's in the board feet. And the next one is about the wood chips. And the wood chips you have only 4,000 cubic feet, so it's a very small amount. It's a very small amount. And the fine grade lumber actually can sell at a higher price, which is $6 per board foot. For the wood chips, it's going to be $1 per cubic foot. So somehow you can guess that if you sell all the fine grade lumber, you're going to receive 300,000, and for the wood chips, it's going to be just 4,000. So it's quite small for wood sales. So apparently we can define that, okay, wood chips seem to be the byproducts. So that's how we start with. Then we have inventory information. We start with the 50,000 production for the fine grade lumber, and we can sell 40,000 and 10,000 board feet actually left in the ending inventory. Then we have a wood chips. So we have 4,000, and you sell 1,200, and you have 2,800 left in the ending inventory. So this is basically the background of the question. Now how we can resolve the cost allocation, how we can allocate the 250,000 joint costs, how to define CGS, how to find the income statement, how to deal with the balance sheet for the inventory. So these are the questions we have to look at. Accounting for the byproducts has 2 major methods. One is the production method. So the production method recognizes the byproduct inventory as is created and the sales and costs at the time of sales. So for the byproducts, when you come up with the NRV, so this NRV is going to offset the cost of main product. Okay. For the sales method, will recognize no byproduct inventory. So, but when you have a sales of byproducts, you can recognize only sales. So the byproduct costs are not tracked separately. So this is what's happening here. So I'm pretty sure after I go through all these 2 methods, okay, you will have a better understanding in the through the example. So just by reading these 2 descriptions, it can be very difficult to follow. So what I'm going to do next is I'm going to go through one particular example to show you how we can do that. So this example is from the textbook. So what's happening here is once again we continue the information we had in the beginning of the this video lecture. So we have a fine grade lumber. So okay, so we are going to look at, okay, so we have sold 40,000 board feet, so we have the following revenues. Okay, and for the production method, you can see that, okay, it recognized byproduct inventory as is created. So definitely we have 4,000 cubic feet. That's what we have. Okay, so that's quite interesting here. And the sales and the costs at a time of the sale. Okay, so we recognize byproducts and sales, but we don't actually consider that's part of revenue. We just use the NRV from the byproducts to offset the cost of main product. So therefore, the total revenues right here, we still recognize only 240,000 coming from this main product, Okay, so now let's go to the CGS component. So what's happening here is first of all the CGS, and the total manufacturing cost we know that is 250,000. Okay, and because you can manufacture, you end up with 4,000 byproduct, for these wood chips. So therefore, the revenue for byproducts we're looking at 4,000, the 4,000. All right. So the net manufacturing cost will be 246,000. This 246,000 is for entire 50,000. So you might want to divide 246,000 by 50,000 to find out per every board foot, what is the CGS cost. Okay, then you multiply that by 40,000. That's how you end up with 196,800 and 49,200. So this will tell you the CGS. Then you are going to use 240,000 to minus this CGS to end up with the gross margin. So gross margin is 43,200, and you can also find out the the gross margin percentage. Then we come to the inventory cost. So we know that the ending balance for the fine grade lumber is calculated already, and for the byproduct we do recognize the inventory. So we have 4,000 in the beginning, then we have 2,800 left. So that's about this production method. You can see that the net realizable value for the wood chips will be used to offset the CGS. Now let's come to the sales method. The sales method does not recognize the byproducts at all. Okay, does not recognize byproducts at all. So that's what's happening. So we started with 240,000, and because we sell wood chips for $1 per cubic foot, so we have additional revenues, which is 1,200. So then we have 241,200. Okay, that's about total revenues recognized. Then we come to the 240. So for the 240, we are going to use the 240 entirely for this 50,000, for the 50,000. So we don't actually recognize this inventory, the CGS. We just dump all the 250,000 to this fine grade lumber. Okay, so that's how you do that. So you have 200,000 CGS, then you have 50,000 in any inventory. So you can come up with the gross margin, which is 41,200. You can see that there's a big difference between these two, because for this one it's 2,000 larger than that one. Okay, so they become differences. Then gross margin percentage is different. Okay, and you have different results. So you can see that both methods they will affect the gross margin and gross margin percentage, eventually inventory separately. If let's assume that you want to have a better gross margin result, then you go with the production method. Okay, and definitely you have a high inventory. Okay, which is consistent because the whole idea is if you have a smaller CGS, so normally you are going to report a higher gross margin. Then you're going to have a larger inventory cost in the end. So same for the sales method, that when you have a small gross margin, then you tend to have a smaller inventory. Okay, smaller inventory. So that's very typical relationship. So now you can see that the production method is more consistent with the matching principle, is more preferred, which you can tell that we consider the allocation of expenses, and we do have inventory recognized. But the sales method is much simpler, because whenever what we need to do is we don't have to worry about allocation of CGS. It's all the CGS will be allocated to the main product. That's very simple. And when we have extra sales, we have this 1,200. So it's very easy to handle. Okay, very easy to handle. So it's simpler and allow firms to manage reporting the earnings by timing the sale of the products. So as an investor who is looking at the financial statements, you would be careful with which method they have applied in terms of byproducts. So if they apply the sales method, then I would be very cautious, because maybe there are some earnings management issues there. For earnings management issues, you have to be especially cautious. They might manipulate earnings and income statement. So that's basically the tricky thing here. Alright, so next let's take a look at an example taken from the textbook, the back of the book exercises. So this question is kind of similar, but it's a little different because it's talk about food processing, which is different from the furniture industry. So what's happening here is we're looking at one company and they have two outputs. One is potato chips, one is a byproduct. So and we have their production in pounds and we have their sales in pounds and also selling price per pound. Okay, and the cost of operation I would consider joint cost. We are looking at 500,000. Now the question is we have two major methods. One is called the production method, one is the sales method. When we apply these two methods, how we can find the gross margin, CGS, and finally what are the inventory costs reported, okay, for main product and a byproduct and the two methods. So we are going to apply a very similar procedure compared to the class example in this particular case. So we're going to apply something similar. So we're going to start with the production method, then sales method. We're going to go through all the calculation details to find out, okay, the gross margin and any inventory and things like that. Alright, so let me first I think I will need maybe three major wider columns. Okay. Alright, so I think that should serve the purposes. Then I will make it a little bit bigger. So this is I would say production method, and this is a sales method. Okay. Maybe too big. Let me make them a little bit smaller. Okay, perfect. Then we start with the revenues. Okay, for the revenues, you should think about, okay, one is a main product, one is a byproduct, right? Okay, then you have maybe a total revenues, so which is a standard. For the production method, so we don't really recognize byproduct profit. Okay, we don't recognize that. Okay, so we apply different way to eventually have correct the revenues. So we use the NRV for byproduct, which is the net realizable value of the byproduct, to offset the CGS of the production, okay, of the main product, to kind of show the revenue contribution from the byproducts. So for this one, we are going to multiply this is $16 by your total sales. Be careful, it's not production total sales. So we're going to multiply 16 by 42,640. Okay, so that's the first step. We'll multiply $16 by 42,640. Okay. Sorry about it. Okay, give me a second. So we end up with $682,240. Sorry, $682,240. Okay, so it should be the same for the sales method as well. So I'm not going to worry about it. So it's the same number. So now let's come to the byproduct. For production method, we're going to recognize nothing. Okay. So we don't recognize the byproduct. We only use NRV to offset the CGS part, so don't worry about it. Okay, so finally, we should have this number. But for the sales method, it's quite different, because for sales method, we are going to recognize the byproducts being sold. So from that perspective, we are going to multiply $10 by 6,500. Okay, which is you can easily see that from this slide. So that's how we get this number. So the result is 650,000. So therefore, you can add these to report the total revenues. Okay, the total revenues. Okay, so which is 747,240. So you can see the those total revenues. Okay, now I'm going to put the total revenues. Okay. Then we are going to go with the CGS, because CGS will eventually let us find the gross margin. For the CGS, okay, and we started with the total manufacturing cost. I don't have too much space, so I'm going to put a manual cost. So for both methods, we have 500,000 for sure. Okay, no doubt, pretty straightforward. So now the question is how to allocate 500,000 for the production method. Because we recognize revenue, so we're going to use the NRV by product, okay, to offset. So I'm going to put actually negative value of you can go back to the question how many we have. So we have 8,500, okay, and selling price is $10. So we multiply 5,500 by $10 to figure out the NRV value for by product. Okay, so that's what we do. So we have a negative 10 multiplied by 8,500. Okay. Okay. And for this NRV by product, we don't do anything. Okay. So therefore, this the net, okay, CGS is available. Okay, which is a result of the these numbers. Okay. So after this net CGS, actually I would just add one more step, which you don't see in the class example and also the solution I give you. Okay. So I'm going to call CGS per unit. Okay. In this case, I'm looking at 415,000 divided by, actually, sorry, I don't know why it's getting slow. Divided by the 52,000, the total production for this potato chips. So I will divide this by 52,000. Okay. So I will get the unit, single unit. Now for this one, I'm going to divide 500,000 by actually 52,000. Okay. So that's what's happening here. Now because of this, I can find the the main product left in any inventory. Okay, because once I can find the main product left in any inventory, I can go ahead and find the rest. So we have main product left in any inventory. The question has given the information already. So we have a 52,000 minus 42,640 to give you the any inventory for this main product potato chips. For the byproduct, you can use 8,500 to subtract 6,500 to find the any inventory. So that's what's happening here. So I'm going to go ahead and do that. So for this main product in the inventory, I'm going to multiply this the CGS per unit by 52,000 minus 42,640. So that will basically give me the numbers. Okay, so the inventory cost. For this one, it's going to be actually very easy because you just multiply this by, you have the pretty much all the calculations already. So let me go back. I think I did some incorrect calculation here. For this one, sorry, I have to redo the calculation. Yes. For this one, it's going to be 500,000 divided by 52,000. Okay, 52,000. Okay. Then I'm going to multiply this number by 52,000 minus 42,640. Okay, 640. All right. So that's what I have. So I end up with the 90,000. So now the CGS, okay, of the sales, okay, the CGS. All right, so I should shift them here a little bit. We're looking at CGS category. So for this one, it's going to be the net CGS, then minus this main product in any inventory. Okay. So it's kind of similar to the next. It's going to be 500,000 minus 90,000. Okay, so that's what's happening. Then we can come to the gross margin or profit margin section. Okay, and we are going to use the total revenues to minus the CGS of sales. Okay, and same for the sales method. Okay. So all the accounting concepts are still the same, just different approaches. Okay, when we come to the calculations. So you can also go ahead and find the gross margin, okay, percentage. Okay. So in this case, it's going to be the gross margin divided by the total sales revenue here. Okay. Sorry. It's going to be divided by total sales, which is right here. Okay, and for this one, it's going to be this gross margin divided by total sales right here. Okay, so we have a 50% and 45%, and so. Okay, so now we can also come to the ending inventory part. Okay, so in terms of inventory, okay, we have actually some value already. So you have a main product, okay, which is actually given, and you have the byproduct. Once again, we are using the two methods, production method and the sales method. For the production method, okay, you do recognize the inventory for byproduct. Okay, for the byproduct, we're looking at the following. So you go back to the slide, it's $10 per pound, and we have actually 2,000 pounds left, which you can do the math here. So it's 8,500 minus 6,500. So you have a 2,000 pounds byproduct left in the ending inventory. So and each pound is worth $10. So I'm going to go ahead and do the calculations. It's $10 multiplied by 8,500 minus 6,500. Okay, so I end up with the 20,000. And for the sales method, we don't recognize any inventory for the byproducts, so we don't actually recognize any inventory of byproducts. So we're done with that. So now you pull out some numbers in your CGS calculations. Okay, in this we have a sales method, and this is a main product in inventory. That's left. That's any inventory. So you should pull out 9,000 directly, and for this one, it's going to be in the production method, and we're looking at 74,700. Okay, and for the byproduct is 2,000 mainly. Okay, sorry, I don't know what's going on here. I think I should not have this. So that's what's happening here. Of course, if you want to go ahead, you can add the total. Okay, so this will be and for this one, it definitely should be 9,000. Okay. So now same thing here, and you have a larger any inventory under the production method. Okay, so that's why you have a larger gross margin, because the inventory is larger than CGS is smaller, than gross margin is larger. Okay, and the same here. Okay, so it's a smaller. That's why for the smaller inventory, you have a larger CGS, then you end up with a smaller gross margin, and things are like that's how those numbers follow. Okay, so I think that's it about this particular example. I hope that helps you understand the production method and the sales method, and keep that in mind. Both the methods are very, very unique, and we don't really see these two methods very often. That's why you have to study them very well, and you can see that the calculations are a little bit strange to compared to our previous studies. So you might want to focus on these two methods. Make sure you know that what is recognized, inventory or NRV. Okay, which one to offset which one. How to consider revenues of byproducts. Should we recognize revenues by product? Yes or no, and which method? How we handle the CGS. Should we allocate the CGS to the main product only, or to the byproduct only, or there are some issues you might want to pay attention to. So make sure you're familiar with the calculations and the steps, and also you may understand that most likely the sales method reports actually the much smaller gross margin, because it does not recognize any inventory for the byproducts. So the CGS is a little bit inflated. When the CGS is inflated, inventory is deflated and the gross margin is deflated. So that's how you can compare these two methods. For the production method, it's more, as I said in the slides. So production method is following the matching principle. So actually should be more used in courage. Okay, but the sales method has a problem. Sales method has earnings management issues there. So you got to be careful. If you read any financial reporting with the disclosures saying, okay, we're using the sales method for byproducts, you might want to be careful, because if you look at this case, 5% is a big number. The gross margin percent of 5% is a big number. Okay, so don't get me wrong. So that's something very important. Okay, and also you look at this $4,000 to whatever dollar difference. If we are looking at a large company, so you can easily go to 4 million, for example. So that's really scary inflation here. So anyway, and I hope you enjoy watching this question, the video lecture.